Hey, welcome to video number 12 in the series. This video isn't going to talk so much about your system and working on your system and your money management, that sort of thing. I'm going to talk about margin trading, but there are some numbers that are related to the things that I was talking about. How much you risk and your stop losses and stuff like that. So I think it is relevant. I also wanted to talk about it because I think there's a lot of misinformation about margin trading, and a lot of people maybe are really scared of the concept. And I kind of wanted to show how it really can be the same as normal trading if you treat it the right way. So what does it mean to be margin trading? What it means is that you're going to be trading with leverage. You might have heard of that term too, trading with leverage. What that means is, let's say you have $1,000 and you want to buy $10,000 worth of, Bitcoin or a stock or whatever it is. Obviously, you don't have that much money, so what do? Well, you borrow it the way you would, borrow money from like a bank, right? So you borrow that $9,000 that you need, essentially from the exchange, from the broker, or, it could be different places, but essentially it's not your money, right? So now you can trade with $10,000. Now that might seem risky, like you're trading with way more money than you have. So on the surface, yes, it can seem risky. Now here's the thing. The bank or whoever you want to pretend this is who loaned it to you, they are not going to lose any money on this. They are not going to lose a single dime of this money. So what happens is, if you get into a trade here, and the trade goes against you, right? In this example, if the price dropped 10%, right? At that point, your $10,000 investment has lost $1,000, right? 10% of 10,000 is $1,000, which means at this point, you've lost 1,000 and you have $9,000 left, right? I'm just going to write 9K. Well, like I said, the bank's not going to lose any money. So what they're going to do is they're going to force you to sell it there. And they're going to force you to sell for $9,000. They get their $9,000 back. You get nothing back because your $1,000 is gone, right? Now, of course, if you had a $10,000 investment and it was all your money, the price could go down to $9,000. And yes, you lost $1,000, but the price could go back up. So you're kind of still in the market. In this case, no, you're done. You're out. You lost 100% of that money. That moment where they force you to sell, sometimes it's called a margin call. It's a liquidation because, they force you to liquidate your asset at that point. And that point can come in different places depending on how much leverage you used, right? So in this case, this number here is your margin, and this number here is, this number here, is the leverage. And then this becomes your full position. So in this example, you would have what's called 10x leverage because you borrowed 10 times more than what you have. But, you can do something as little as 2x leverage, and in some cases as high as like 100x. And you'll constantly hear people say, try to keep your leverage low, 2x, 3x, stay away from 100x. That's crazy. Those people are nuts. But in the next section, we'll kind of talk about why it's sort of irrelevant. But in general, what this means is that if you're trading 2x, so if you had $1,000 and you're trading 2x, that means they're going to let you borrow another $1,000 for a total of $2,000, right? And the bank's letting you borrow 1,000 of those dollars. And 100x, you put up that same $1,000, that means you're playing with $100,000, and the bank is putting up $99,000. So if you had a $2,000 position size, right? If you're going 2x and you have a $2,000 position size, you buy here, how much does the price have to drop before you go through your 1,000 and the bank wants their 1,000 back? That would be 50%, right? Because after a 50% drop, that first $1,000 is gone, that's your 1,000, and then the bank says, you're liquidated, you have to sell, we get our $1,000 back. With 100x, that would only be 1%. 1% from 100,000 is a $1,000 drop, and the bank wants to get back their 99,000. That would mean it only has to go down 1% for that to happen. So after the price drops 1%, they liquidate you, they get their money back, you lose your $1,000. So the basic concept is the higher your leverage, the closer your liquidation price will be to where you got in, right? So you might assume, well, going 100x is obviously very dangerous because if the price only has to move very little for you to get liquidated, lower leverage, the price has to go very far for you to get liquidated. The first point I would say there is that it really depends on the asset. Like, how much does this thing swing? Some things only swing little 1% at a time. Some things swing in 20% swings. Are you holding them long term, short term? So even these percentages, might be a good thing or bad thing depending on, the charts. So just to go over why I think a lot of the numbers and stuff don't really matter at the end of the day when it comes to margin trading. Like these leverage amounts, I think can be arbitrary if you think about them a certain way. So let's say you have like a $10,000 account. $10,000. I hope you can tell that is a $10,000 account. And you want to risk 2% of that, right? Which equals $20. So you're risking, $200. So you're risking 2% of your $10,000 account for $200. So let's say you want to put up $1,000 of your own money on a trade, and you want to go 10x leverage, which means your position size is $10,000. Let's call this trade number 1. Your position size is $10,000 with 10x leverage, so your margin is 1,000. That means the bank or the exchange is letting you borrow $9,000, right? And so if you have a $10,000 position and you want to lose $200, what does that mean? That means the price has to go against you 2%, right? $10,000, just to prove it, $10,000 times 2% is $200, and that's what you wanted to risk. So you put your stop loss 2% below the price. Well, the liquidation price, as we mentioned over here, for something that's 10x would be 10% below the price, right? It would have to come all the way down to $9,000, and to lose that $1,000, the price would have to go down 10%. So let's look at another example. Let's say in this example we want to do that same $10,000 position size, but we want to go 20x. Now, I'm kind of working the other way now. That means I'm only putting up $500 of my own account, right? Of my $10,000, I'm using even less. I'm going 20x, $10,000. But I still want to risk $200 on that trade. So in this case, the bank is letting me borrow $9,500. And so how much does this have to go down to risk $200? The same thing, right? It's the same 2% drop. 2% drop, and I lose $200. And at 20x, to get to $9,500, I would have to lose $500, which means the price would have to drop 5%, right, to get liquidated. So in both of these cases, I lost $200. One I used 10x, one I used 20x. Different amounts of margin, but the same amount of position. Let's do a third example. This one I'm going to use that same $1,000. I'm going to go 20x on this one. So now my position size is $20,000, right? And that means, $1,000 here. So that means that the bank is letting me borrow $19,000. So now if I have a $20,000 position and I want to still only lose $200, that means the price can only go against me 1%, right? $20,000, times 1% is $200, right? For me to get liquidated, for it to go down from 20,000 to 19,000 is actually a 5% drop, right? 20,000 times 5% is $1,000, right? It has to go down $1,000. In all three of these cases, I will not get liquidated because the liquidation price is below my stop loss. I'm not allowing it to happen. So what are we seeing here? We're seeing that I can use different amounts of leverage. I can use different amounts of margin. I can use different amounts of position size. I can let the chart go different percentages against me, and they will all lead to the same loss, right? So the math actually shows that the amount of leverage, the amount of margin, all of these things are sort of arbitrary. As long as you're not getting liquidated, it kind of doesn't matter. So then the question becomes, how does this help you? Why would you want to do this? Why wouldn't you just want to put the full amount, right? So the first thing I would mention is that in this case, this trade and this trade were the exact same trade, right? It was a $10,000 position. The price So if I'm basing it on the chart, the chart's going up and down, and I'm like, you know what? I think I would like to get out there. That happens to be 2%. This is the same on both of those. So in this case, I was only using $500 of my $10,000 account versus $1,000. So I was using less of my money. What that means is now I have more money freed up to put into different trades. There's an opportunity cost applied to when you have money in a trade. And businesses do this all the time with leverage. They will take out a loan from a bank at like a 5% interest rate because they think they could make 10% return on that money, right? The concept of a mortgage on a house is like you're trying to buy a house that you can't afford. The bank's loaning you the money. Like you're using that loan as leverage. So it allows you to play like a bigger game without having to put up that much of your own money. The other reason why it actually can be really beneficial is, let's say you want to buy something here and you think the price is going to go down 1%. Right? And that's just what your signal is telling you. The chart says once it goes down 1%, I'm out. And let's say you have that same $10,000 account and you want to risk the same 2%, which equals $200. So your risk is $200. How much money do you put into this trade so that if you lose $200? You can't, right? You have to put in $20,000 for a 1% drop to equal $200. So what's happening here is you actually don't have enough money to risk the amount that you want. It's forcing you to risk less. And obviously in everything we've talked about in previous videos, you want to risk as little as possible, right? But sometimes in this case, 2 might be a very conservative number for you and you're very calculated about that number. You want to risk more. You need to risk that 2%. And you can't do that on a 1% drop. There might be a trade that it goes down 0.5%. Again, you can't risk $200 on a 0.5% drop without some kind of leverage, right? So in this case, you can use 2x leverage, and that would mean you put in 20,000, right? And that means if you lose, 1% of 20,000 is $200. So that 200 is your $200 risk. In this example, you would have to go 4x, right? So they let you borrow money, so you go up to $40,000. And 0.5% down from $40,000 is also 200. 40,000 times 0.5% is $200. Now you could even have a case where you think the price is going to go down 2%. Now you can achieve that. You could put your entire $10,000 account, and if the price goes down 2%, you would lose $200. But maybe, like before, you don't want to put your whole account in. You want to be able to move your money into different trades. So you can use like a 10x leverage or 5x or something like that, and that way you preserve some of your money to do other kinds of trades. You might be thinking, well, what kind of trades are getting these small little percentages? First of all, in 4x in a lot of markets, they move very little. You might get a 2 or 3% move in an entire day. So that's pretty normal. But even if you're trading like Bitcoin, Bitcoin took a shit today and it's at like $6,300. And let's say you want to bet that it's going to go up to 6,350, right? That's not that crazy of a trade. So what you would do is 6,350 divided by 6,300 equals that minus 1. I believe that is correct. That would be a 0.79% increase, right? The price from there to there is a 0.79%. That might not be exactly right, but I'm pretty sure it is. So what that would mean is if you're betting the price is going to go from 6,300 up to 6,350, a $50 move, let's say you have a 1-to-1 ratio, that drop would be 0.79%. And you have the same problem as you had here. If you want to risk $200 with a $10,000 account, you can't do that. You can't risk enough. So your risk is actually too low. And that's why leverage can actually be a tool that is useful for a conservative system. 2%, risking 2% is not super aggressive. A lot of people will talk about 100x and 50x. That's crazy. These people are degenerates. But it's look, if you can make the numbers work out the way you need them to work out, at the end of the day, that's what I've talked about in a lot of these videos. People kind of hype up what's a good number and a bad number. It's all about how you make it work. So the last thing I want to mention is that getting liquidated is actually worse than putting a stop loss. You can just Google liquidation versus stop loss, and there's a lot of people who will crunch the numbers and show why it's worse. So just to explain, if the price is here and it goes down and you think, okay, well, I'm doing 10x, and 10x I should get liquidated at a 10% drop, right? That's a 10% drop. The problem is the exchange loaning you the money, the broker, whoever it is, at that point, what happens is they have to sell everything you own, right? But to sell, that means somebody else has to be buying, right? There has to be somebody on the other end of the trade. And what if we're going through a big rush and everybody is selling at once and the price is just taking a shit and they can't sell it there because there's nobody buying on the other end. There's too many people selling that are in front of you. And so what happens is they end up selling it here. Well, in that case, they would have lost money because remember, the distance between your entrance and the liquidation price, that's your money. Anything below that, that's their money. And like we said in the beginning, they are not going to lose money, right? So what do? Just to keep it clean, if this is what you think your liquidation price will be, it would actually be like here. And so they liquidate you a little earlier, right? So that just in case if it keeps dropping, they have that little wiggle room. And that's because of something called maintenance margin. And it really depends on what you're trading. If you're trading on different markets, it can get really complicated. I don't want to go into that. But essentially, if this is your liquidation price, you could just set your stop loss literally right at the same price, and you would lose less money than if you got liquidated. A lot of people will say, okay, I want to risk $200, so I'm just going to make it so that, if I get liquidated, I lose $200. I'm just going to go in with 200 margin, 100x, whatever. So it's good to just keep that in mind. It's better to use a stop loss than to rely on liquidation, because if not, you're kind of just giving money to the exchange. So that's it for the margin trading video. I think it could be a very useful tool, and you kind of shouldn't be afraid of it just because there's all these people using it essentially to gamble. You can use it in a very conservative, systematic way, just like you can any other form of trading. So I'll see you next time, and thanks for watching.